Ethics, Real-Life Application of the AICPA Code of Professional Conduct was a live webinar that was originally produced on Tuesday, November 14th, 2017. For this webinar, we were joined by two of our partners here at McKonly Asbury, Janice Snyder and Mike Hoffner. We hope you enjoyed this webinar recap, and please visit us online at www.macpas.com for more information about our future webinars and other events.
Our audit segment, and we are going to spend our time walking you through some of the Code of Professional Conduct as well as case studies. So hopefully this is a little more interesting as we give some real-life application and some practical examples to this. So on the next slide is our standard disclaimer, because Mike and I did not write these standards, but we are going to quote them quite a bit, and we're going to walk you through these case studies. So just keep that in mind, that we aren't the ones that wrote them, but we do understand them pretty well. So our program outline today is pretty simple. We do have to spend a few minutes updating you and reminding you on what the AICPA Code of Conduct is. So a quick refresher, we'll go through a few slides there on how it's organized and some of the key points there, as well as the conceptual framework. And then we're going to take those key points in that conceptual framework and walk you through two case studies related to members in public practice. And I'm sure there's no surprise they'll focus quite a bit on independence, which happens to be a big concern for those of us in public practice. And then we'll walk you through case studies of two case studies that apply specifically to members in business. So that is our agenda for the next 50 minutes. And with that, I'm going to turn it over to Mike to start out with an overview.
Thank you, Janice. Yeah, so as Janice said, the struggle with doing an ethics presentation is that it's an in-depth code of conduct, and it's always a conversation about how you make it interesting. So hopefully, I agree with Janice, hopefully a little bit of case study discussion will make a dry topic slightly less dry. I'm also always excited by the number of people who sign up for ethics webinars. I'm sure it has nothing to do with the fact that it's November of a reporting year in Pennsylvania, and everything to do with the fact that we all want to be as ethical as possible and want to understand the ins and outs of the Code of Professional Conduct. So as Janice said, it's the right place to start is a reminder of what the code looks like. When this code first came out, we did an extensive series of webinars and presentations on it. So some of you, because that may have been a reporting year as well, may remember some of that dialogue. So we'll keep it at a high level now. But if you go and look at the AICPA Code of Professional Ethics, Code of Conduct, it's a 193-page document that is organized really to walk through a thought process on how to make a decision on handling a potential ethical concern, not as much a set of rules. So the old code was really a series of rules with interpretations. Over the years, as those rules and interpretations were superseded by new thoughts and ideas, if you went back and looked at that code of conduct, you would see a tremendous amount of blank space on the page because things continue to get taken out and new things were put in at the end. So it was a longer and longer document with less and less really relevant information and useful information that you could navigate through. New code is really focused on a conceptual framework idea with some examples baked in, but it's not intended to be a let's go to the code, let's find an exact situation that we're in the midst of, and the answer will hopefully be there for us, because that just wasn't working, and that's how the old code was really set up. Old code was set up for everybody. There was no distinction between those who are in public practice and those who are in industry, and heaven forbid if you were retired or between jobs and weren't sure if you were in public or private. It was really hard to find anything that spoke to you and how to navigate through ethical decisions. So the new code really tried to fix that and has very distinct and clear sections on each of those key categories. So, as I said, the code is really geared toward those three categories, but the bulk of it, as you can imagine, is focused on members in public practice and a section for members in business. That section on retired or unemployed individuals, fairly short, some specific things that you would expect to see in there, like if you're a CPA, you need to file your tax return, things like that. But really the focus is what is the process to think through if I am in public accounting, if I'm in public practice and providing a professional service, what's the process I need to go through? And then a separate section if there's some thoughts and conversations I need to go through as I'm sitting in a chair in industry. I'm working for a nonprofit or a commercial organization. Really clear discussion and interpretation, speaking specifically to those folks, finally with recognition that depending on what seat you're sitting on, the concepts you have to think through and the ethical decisions you're faced with are actually very different. So again, the Conceptual Framework was released on December 15th of 2015. Again, that was also a reporting year in Pennsylvania, so I'm sure a number of you sat through ethics presentations and probably heard all about it. It was hot news and interesting news back then. In the last 2 years, not a lot has changed in the code, which is why we're going to focus a little bit more today on more of a case study and how to work through it. So the conceptual framework idea and that concept is really focused on a threats and safeguards approach. That idea being, as you sit down and are faced with something that maybe makes you a little queasy or you're worried about the optics of a situation you're in, we would consider that a threat. So as we identify that threat to our compliance, and I'll take a moment here to remind you that that threat to compliance is not just independence. Way too often when we think about the code of ethics, we think about public accounting and we think about implications on independence, but there are a number of different threats that apply to public accounting that have nothing to do with your independence for an attest function, an audit, or a compilation. And there's a number of obvious ethics situations that speak to those who are in business and have nothing to do with those in public accounting. So when we talk about compliance, we're talking about compliance with the ethics code and the rules surrounding ethical decisions. We're not talking just about independence. So let's keep that in mind as we go through our presentation today. As we identify those threats, step 2 is to think about the significance of the threat. So a simple thought, a simple example when we talk about evaluating significance, we have 2 situations I'll throw out, and they're not part of our case studies. If you're faced with something, say, as simple as if you're in public practice and a client offers you a coffee mug to take back to your office with their logo on it, that's a gift. That falls under the rules surrounding gifts. So we have to think about, is that a threat to my compliance with the rules? The exact same rules apply to a client offering that same accountant an all expenses paid trip to Barbados. I think we would all agree one is significant, one is not. Reality is we can't ignore one because it seems insignificant. It's still a threat, it still needs to be evaluated. So that's the next step we go through. And then finally, if that threat, if we've identified too high of a significance to our compliance with the rules, we put in safeguards. And we put in enough safeguards, so for instance, we don't go to Barbados and we say no thank you, but we probably could accept that mug. But we have to put enough safeguards in to eliminate that threat and reduce it to a level that says we can go forward. So our next slide is a very simple visual of that. Identify your threat. If there are none, we continue. If those threats are insignificant, it's a coffee mug for Pete's sake. Maybe it's full of Hershey's Kisses. Still probably insignificant. If we move to a point where we believe that threat is significant, now we need to consider the safeguards that will allow us to comply with the rules, whether they be the rules surrounding ethics for those in business or the rules surrounding ethics for those in public practice. And ultimately, we have to reduce those threats to the point where we believe they won't impair our thought process, nor would an external party view them as also impairing our thought process. So with that, I'm going to turn it back over to Janice to talk a little bit about the first section of the code, which is applicable to all of the folks, not just one bucket or the other.
Sure, Mike, thanks. I loved your coffee mug example. So I just had a team a couple weeks ago. We were out at a client and got this wonderful box of candies, and they were delicious, and the team was so excited. And they all stopped and said, "Can we accept it?" And I said, well, let's talk about that. Let's talk about the threat and the significance. And they were very pleased to know we concluded that we could accept that, and they were quite delicious. So we all enjoyed them. So as we move through, I'm going to start with the preface here. And the preface applies to all members. And we will do this pretty quickly. There's really 6 principles, and no, they're not all independence. Part of one touches on independence. But the first one that we have to comply with is the responsibilities principle. So we have to make sure that we exercise sensitive professional and moral judgments in all of our activities. And this responsibilities principle really focuses on maintaining public confidence and the whole concept that as CPAs, it's self-governance. So we have to self-govern ourselves and make sure we're watching those around us as well. So we have that responsibilities principle. The second one is the public interest principle. So we have to accept the obligation that we will serve the public interest, honor the public trust, and demonstrate a commitment to professionalism. So this goes really beyond just what's written here, but that public trust and public interest is to clients, creditors, governments, employers, and if you're a member in business, to potential investors, to the capital markets, to bankers. The list is rather extensive of who relies on what we do as CPAs, and the public interest principle is held in very high regard. The next principle is integrity. A lot of people say this is fundamental to our profession. Without our integrity, no one will believe what we're doing. They won't believe our numbers. This really makes us rely on all the information that we do to be honest, candid, and to maintain appropriate confidentiality in our daily responsibilities. The fourth one here, objectivity and independence principle, really pulls in that independence. So a lot of times that applies to individuals in public practice. But you have to make sure in your jobs as well as a member in business that you are remaining free of conflict. And then when you go to the public side, you have to be independent in fact and appearance. So when they talk about this standard, that this is really this objectivity and independence principle is about a state of mind. Can you truly be impartial in the role you're filling, and can you be honest in what you are doing? And that's really important here. The next principle is the due care principle. So part of this is to maintaining high technical and ethical standards, and a lot of this in maintaining competence ties in your training and education, so part of the reason you're on the webinar here today. But it really focuses as well on a quest for excellence. So as a profession, we really need to be focused on that quest for excellence. And yes, they are the exact words in the standard. So scope and nature of services principle really says that in everything we do, we have to apply the 5 principles above. So it really focuses on integrity, objectivity, independence, but it's all of them saying that when we agree to do something and we agree to take on those responsibilities, we have to know the scope and nature of those services and make sure they can comply with all the other 5 principles.
Janice, you are absolutely on a quest for excellence here. So
Thanks,
let's
Mike.
continue as we move into our discussion here on the case studies. As Janice had mentioned, the first 2 case studies are geared towards members in public practice, and they do lean towards an independence type discussion. So this is the part of the discussion where those of you who are in industry are going to be really tempted to tune out and read your emails and check all the latest on the stock market and the sports transactions and all that good stuff. But I encourage you to stay tuned, to stay engaged, because some of this stuff, while specific to members in public practice, will absolutely speak to those of you who sit in business, because it has to do with how you interact with the firm that does audit and compliance work and tax work for you. So as we get into part 1 and we get towards the case studies, part 1 is geared towards, as we've said, members in public practice, those who are serving in an audit, an attest, a tax environment. So generally we think of those as individuals who are in public accounting firms or sole proprietorships, or hanging out their shingle and doing work after hours as a service provider. But the code is very clear also to include governmental auditors working in a governmental organization, which is something that was excluded from the old code. There are more specific and granular rules in the governmental arena on independence, and this does not supplant or replace those. But they are very clear to say that as a CPA, even if you're in the governmental area, these rules apply to you, and these things need to be considered by you in the way you go about your business. So framework we've already talked about: identify threats, evaluate the significance, and if that threat is at a high level of significance to your ability to comply with the rules, we have to identify and apply safeguards. So let's talk a minute about what those threats might be. The code goes into some pretty significant detail, not only laying out specific definitions for each of these types of threats, but also going through examples. In the interest of time and not making this a complete discussion on what all the new code says, I will leave it at this. They're fairly straightforward up there. Adverse interest simply means I might not do things in my best interest because there's something going on with the client, whether they're threatening something, they're threatening to sue me. Advocacy, I'm so excited about what my client does that I might cloud my professional judgment because I'm in their court. Familiarity, I'm so comfortable with them. Things that are fairly obvious in terms of things that we encounter every day, but we don't often think about. We don't often think about the familiarity side of I've been working with this same client for a decade, and we have these conversations as service providers with audit committees all the time. You've had the same team, that's great. Low turnover from the firm, that's great, but you're so familiar with management and you're so familiar with our people here and our processes. How are you staying fresh and how are you making sure we're doing those things correctly? That is a threat to independence that as an accounting firm we take seriously and that we think through on a regular basis. But it's not just because our clients are asking us the question. It's because the rules say it and we have to follow that thought process. So long list of threats. So we're bouncing around here. Long list of threats to go through. It is a number of pages within the code, but some great examples of things you may not be thinking about, and they're just everyday life things in public accounting, but they're specifically identified as things we need to consider in the independent side. Safeguards are those things that eliminate or reduce our threat to an acceptable level. We've talked about where acceptable level is. You can't always eliminate a threat, but there is a point where that coffee mug full of candy is just something we're not going to worry about. And there's a number of different safeguards to think through. There are those created by the profession. We have CPE rules and requirements that help us with understanding ethics rules. That's why many of us are here today. There's peer review, which gets into things like independence and your objectivity processes in an accounting firm. There are safeguards created by clients. So many organizations have rules and regulations and have code of conducts on how they deal with outside service providers. So sometimes, as a service provider, you should be thinking through some of these things and having clear safeguards. Often your client has done it for you, and if they're complying with their safeguards, we're sure that they're not going to accept a gift we shouldn't be giving, or they're not going to offer a gift to a service provider that might cloud judgment. And then finally, safeguards that are created by your firm. So every firm has a code of professional conduct, a quality control policies and procedures document, and these are things that a firm puts in place which often reference the profession's safeguards, but these are things that different layers and levels that are all in place to help us get to a point where when those threats are identified, we can reduce them to an appropriate level to continue forward serving a client, knowing that we're serving them well and we have their best interest at heart, but also knowing that we're complying with the rules surrounding objectivity, as Janice had talked about. So with that, I think we're going to jump into the first case study, which is really, again, geared towards those who are in the profession, who are in industry. We'll get to you guys in just a few minutes.
Sure, but don't tune out if you're a member in business, because I picked these two examples because I get to research them at least annually. I get to go back and revisit them because I'm always having good dialogues with my clients, and these are two specific things that tend to come up. So I tried to pick ones that may affect those of you in business as well. So the first one is a valuation example. So the CFO of an audit client calls and asks for your firm to perform a valuation of the company. They said, well, it'd be really easy for your firm to do this. You have all the historical records, you have the financial information, you know us, you understand our strategic plan and where we're going, you understand our customers, our vendors. We think you're best suited to do this, and that would make a lot of sense. So the purpose of the valuation is as a potential large sale of stock based upon the stock value as determined in the valuation. So there's some transfer of ownership that's going to go on here. So may a firm provide valuation services to an attest client? So if you consider this case study, I provided the framework here, and the real issue around this is independence. So section 1.200 of the code, it's about 70 pages long, all the guidance that you have on independence. But if you start to walk through that, is there a threat under the code of conduct, code of professional conduct here? And the answer is to that question is yes, there is a potential threat. So then we have to evaluate that threat. Is that threat significant? And the answer to that is really, well, it depends. So if we determine that the threat is significant, then we move on to identifying the safeguards. So the potential threat here is the self-review threat. So independence would be impaired if I, as your auditor, am relying on information that someone in my firm prepared. So in this case, it really does depend. So if we can go to the next slide as we look at this, for members in public practice, this valuation example, a firm may not provide valuation, appraisal, or actuarial services. This came out of some FAQs done by the AICPA. If the results of the service would be material to the attest client's financial statements. So in this case, it's very likely that it could be, but we're not sure. And the service involves a significant amount of subjectivity. So if the firm may not perform this valuation service in connection with a business combination, because a lot of that valuation is going to change the amounts that would be on your financial statements as you allocate that purchase price. And if there's a lot of subjectivity involved, so a lot of assumptions about future projections and a lot of market multipliers that we'll be using, if there's a lot of judgment involved in that, then you may not. However, as you go through the conceptual framework, there are exceptions that the AICPA would say where you can do a valuation. So you can do the valuation, appraisal, or actuarial services for non-financial statement purposes. So maybe you're thinking of some succession planning or wealth management that's really not going to affect your financial statements because you're not going to have that large sale of stock. You're using it for planning purposes at this stage. Then you can look to safeguards. And so the general requirements for performing non-attest services really requires someone at the client to have the suitable skill, knowledge, and experience to review that work, understand the assumptions that go into that valuation, and then you're able to provide that service. But again, you have to look at all the factors. So I think the answer to this is it depends. You probably start in a position of no, we can't do it, but then you work through it. And there are circumstances where an attest a member in public practice who's performing attest services could perform a valuation. The second example there is an actuarial valuation of an attest client's pension or post-retirement liabilities because they would expect that regardless of who was performing that, you would get to the same conclusion. So hopefully that helps you with just one example of how you walk through the framework and what that could mean for your business and what a member in public practice has to go through. And this one really hinges on how is the valuation going to be used? Could it be material to those financial statements? And does someone in management have the suitable skill, knowledge, and experience to take responsibility for the assumptions used in that valuation? So that is our first example. Second example, as I said, these are questions that I get quite often. So this is a CISO, a Chief Information Security Officer of an attest client, requests your firm's support in providing the following services. So they said a best practice review of cybersecurity, including benchmarking against a framework such as NIST, which is a very high-level cybersecurity framework. Advice and recommendations to improve the company's policies, procedures, and internal control relating to cybersecurity threats or practices. And number 3 is attack and penetration testing related to cybersecurity. So again, with this example, you have to start and say, is there a threat? So you think of those threats. Could I be self-reviewing my work? Is there undue influence? Is there familiarity? You have to think of all of those threats and say, do we have a threat? If it's an attest client, I would say, yes, you do. So then you have to move on and say, is the threat significant for step 2? And if it is significant, because it may be in this case, then you move on to step 3 and say, do we have appropriate safeguards? So let's look at each one of these. So can these services be provided to an attest client? So in terms of the best practice review of cybersecurity practices, including benchmarking against a framework, yes, you can provide those services as long as you're providing them as recommendations to the client. I think of our audit processes. We go through controls all the time. We evaluate IT environments and IT general controls, and a lot of times we have recommendations coming out of that. And we certainly want to share those with management if we think it can help them improve their processes. So this really wouldn't be any different than that. We're taking what you're doing and comparing it to a framework. So the AICPA, through their FAQs related to the Code of Professional Conduct, says yes, this is permitted as long as it's only advisory in nature, and we're not actually making decisions for management. So the second one is advice and recommendations to improve the company's policies, procedures, and internal control. The answer to this is yes, we can provide those services, provided they're only advisory in nature. And someone in management has those general requirements for performing non-attest service. So the safeguard here would be the suitable skill, knowledge, and experience of someone in management who's going to take those recommendations, evaluate them, and see if they make sense for their organization and that company. So in this case, yes, those advice and recommendations, that doesn't surprise me. Again, that happens a lot through an audit process as well. So the third one is a little bit different. You look at the attack and penetration testing related to cybersecurity, and the answer to this is it depends. So you really have to think about independence in this example, since this is an attest client. So it will be impaired if the attack and penetration testing is done as part of management's control environment. So if this is a monitoring control, the management says quarterly or annually, we want you to do this, and we are relying on the work you're doing as part of our control environment. So you can't be part of that ongoing maintenance and ongoing monitoring. However, if you say, we just want you to do it one time, give us a baseline, provide us with your recommendations, kind of tell us where we are, we'll take those results and either decide to do it ourselves or put a different process in place to monitor this on a regular basis. There can be appropriate safeguards put in place that you could be able to do this kind of on a one-time basis or periodically and not regularly and not ongoing. So the framework really has a lot of judgment as you walk through these two specific examples. Hopefully that helps you a little bit. I didn't want to spend a ton of time on the two of these because I think much more of our audience are members in business. So Mike's case studies are going to take quite a bit longer, so I'm going to turn them over to Mike.
Thanks, Janice. Before we get into the next two case studies, though, I did want to just take a minute and key in on something that you talked about, Janice. The term non-attest services was used, and that is something that for those in public practice has become a really significant area of scrutiny from the AICPA's perspective, and where that line is drawn between performing a allowable non-attest service, so non-attest meaning anything that a service provider might do for an attest client, an audit client, or review client, anything that is under the attestation standards. There's a lot of things that an accounting firm can do for their clients and still maintain their independence for that attestation function. But the rules surrounding how we document that and what responsibilities of management are, and this is speaking to those of you on the audience who are in business, there are more enhanced rules and documentation requirements around what the accounting firm has to do to ensure that you've accepted your responsibility for those non-attest services to protect their independence. And that's what Janice was getting into on the skills, knowledge, and experience. You as an individual in business are required to take ownership of those non-attest things. And that can be tax returns, preparation of the financial statements, or it can be these things that we've talked about in the case studies here. The other thing I wanted to mention is really surrounding the AICPA's rules versus some of the other rules that are out there. So we're speaking very specifically to the AICPA rules here today. The SEC and the PCAOB have much more specific regulation and rule around what can and can't be done for an audit client, and really the default is if you're in the SEC or the PCAOB world, your audit firm is your audit firm, and that is all. And all of these non-attest services that are permissible under the AICPA rules, if we put certain safeguards in place, are generally very black and white under the SEC and PCAOB. I would say the same for the governmental accounting side. There are some specific independence rules I already mentioned on the government side. Not saying that your accounting firm can't do certain things, but the documentation rules and the requirements surrounding verifying your independence and your objectivity are much clearer and much more different.
Yeah, I would just add to that, Mike, the Department of Labor has some slightly different rules as well that are very specific to benefit plans and some of those services. So just keep in mind, we're focused on the AICPA in this presentation and this specific code of conduct.
Yeah. So moving on from what has always, I think, been the focus of the code of conduct. It's always been focused, and at least our mindset has been that it's always been focused on those in public practice. Now we're going to move into the section of the code that is geared towards those who are in business. The structure is extremely similar to part one. There is some language tweaks that make it sound more specific to those in business versus those in public practice, but the concepts and ideas that we've already talked about, we've talked about the threats being advocacy, familiarity, self-interest, self-review. The exact same things are applicable for those who are in individuals in business, but the examples and the scenarios and the thought process are very different. The safeguards are a little bit different, more geared towards what you do and how you work things through the channel of your employer. If you're an individual who works for an organization, if you are an individual who owns an organization, what kinds of things you need to look to. So we've gotten to a place with this code over the last 2 years that I think, in my opinion, for the first time in a long time, actually speaks to and adds value to somebody in business's decision-making process when faced with an ethical determination. So process is similar though, so let's jump into our first case study. And the two case studies that I wouldn't necessarily say that I'm going to go on a lot longer than Janice did, but the two case studies that we came up with I think would have countless tangents and have countless parallels with slightly different scenarios that I would wager some of you on the call today, on the webinar, have experienced. So the idea here is some of these you're going to read. In fact, both of them I think you'll look at. And when we get to the end of the actual case, the actual the scenario, I think you're all going to say, well, yeah, it's kind of obvious what we would do. And many cases it is obvious what you should do. The purpose of the slides that come after the actual scenario is to walk through what the actual rules say and what the thought process is behind how you should grapple with some of these, because it's not as easy on the surface when you're in the scenario, and I know some of you know that. It's not as easy when you're in the situation as it's going to sound today when we walk through it. So purpose, again, is probably to give you what many of you would say is an obvious answer, but to give you the tools and what the guide says on how you might think through and document your position and protect yourself. As a licensed individual, you have to protect yourself against non-compliance with these rules, otherwise you end up in front of an ethics panel. And we'll talk about that at the end as we have time. It's not a comfortable place to be, and often it's because we were backed into a corner for something that really didn't seem like a big deal at the time, in reality it is. So our first case study, we have a divisional controller of a publicly traded entity who signs off on divisional financial statements, sends them up to the corporate office, answers any questions corporate might have as they put together the filings, the monthly results, the quarterly results, the annual results. And as we got to the end of a Q3, our controller submitted his information, had everything buttoned up, answered a few questions, and then looked through some of the consolidating information that supported the quarterly filings, and noted that there had been some entries posted on what he had submitted. So this is maybe a more of a public company geared example. We talk about, we've heard over the last decade, 2 decades about corporate frauds and how things like this happen. But let's talk through the thought process that our individual here should go through. We think that the entries were made because in the absence of these topside entries that were made in the final issued reports, in the absence of that, we might have missed earnings targets. We might have missed our earnings per share estimates by a very little bit. And miraculously, what always happens, we made them either spot on or just a little bit over. So Nick's feeling a little bit queasy, a little bit uncomfortable with some of the things. He makes a phone call, and his bosses indicate that they made some appropriate topside entries. They were just trying to adjust some of his reserves and estimates to be more reflective of what corporate thought about some of the accounts, and he should go ahead and support them when the auditors maybe ask him about the final numbers. He should support them and send them up to corporate. So what should our individual here do in this case? So the Code of Professional Conduct is very clear in the area of subordination of judgment, and I put a lot of language on the screen here that comes straight out of the code, but at its core, the code is very clear that as a CPA or as a non-CPA who's trying to do the right thing and get some guidelines, so the code of conduct is for certified professional public accountants, right? It's the AICPA, but it's guidelines for all of us who serve in this area. We're prohibited from misrepresenting facts or subordinating judgment when performing professional services for an employer, and that includes differences of opinion with our supervisors. So when our supervisor sits down and says, the numbers you gave me are wrong, and I'm not going to give you a good reason why other than I'm adjusting some estimates, often the outcome of that discussion is, yes sir, yes ma'am, they're your boss, I get it. But what's pretty clear here on the screen in front of us is that a difference of opinion with our boss or our supervisor is something that is specifically a threat that we need to consider as to our compliance with the Code of Professional Conduct. So what should we do there? We have to evaluate the significance of the threat. In our loosely put together example here, the difference is an organization that might have met an earnings target or missed an earnings target because of some entries that were made that I don't fully understand. That's pretty significant to me. So I sit back and say, am I subordinating my judgment to my superior, to my supervisor, in something that I know is significant to the markets that I am supposed to be providing due care towards and making sure that those public markets are the focus of what I'm doing and maintaining my integrity for. So if I've identified that I have a significant concern and a significant threat because my supervisor has done something, what do I need to do? I need to go to the next step and I need to identify what safeguards might be put in place. So in this case, first bullet point, if I've concluded that threats are acceptable, I think in this case our individual has probably not concluded that. I'm good. But if I conclude that there is a potential misrepresentation of fact that's going to the public markets, a violation of laws and regulations, clearly I have a concern, and step one is to go to my employer. Step one is to go to the supervisor, which obviously be the first thing we do. Why did we book these? What are the questions? And quite often we have these concerns and we see it fairly regularly that somebody submitted a reconciliation or submitted information that had an estimate in it, and the chief financial officer and the president and the financial reporting director all sat down and said, you know what, there's some things about this estimate that we're not real comfortable with, and so we're either going to be a little more conservative or a little less conservative. And it's entirely possible in our example here that there were perfectly legitimate and valid adjustments made at the top side, and that conversation from Nick to his supervisor and others in the organization might flesh that out. So step one is not to go to the whistleblower hotline. Step one is to figure out if there's a good reason, because quite honestly, maybe the threat is minimal. Maybe these things are pretty reasonable and appropriate. But if we've had that discussion, our third point on the screen, if it's not resolved after that discussion, then we need to go to a higher level. So in this case, we've used a public company, which would have an audit committee. So if we can't get satisfaction from the financial reporting director or from our direct supervisor or the chief financial officer, there is an audit committee which I would expect that an individual would go to raise these concerns and questions. So as we've worked through, we've now had conversations at all levels, and I believe Nick, in this case, if he'd had all these conversations and raised his concerns through an independent stance to the audit committee, has probably protected himself, although I would always recommend documentation of your conversations and the outcomes, because at the end of the day, if there was manipulation of data for public reporting and you were complicit with it, then you are at fault and you are in violation of the Code of Professional Conduct. One thing that I think is interesting that we don't always think about in these scenarios is there's a very clear section 2.130.30 does specifically talk about the obligation of a member, a CPA, to the employer's external accountant. So if we have a known adjustment that was made that we believe is wrong, and my boss told me to go ahead and support it to the external accountant, The code is black and white. Code very clearly says that when you are dealing with an employer's external accountant, you must be candid and not knowingly misrepresent facts or fail to disclose material facts. So at the end of the day, I think there's a lot weighing on Nick in this case to navigate through. At the end of the day, I think we would all sit down and say, well, if they booked things that adjusted numbers, I'm not comfortable with that. I'd run it up the flagpole. I'd probably go to the audit committee if there was one, and I might engage an attorney because now I'm kind of stuck with this and I don't know what to do. We all might get to the same conclusion, we might not. But reality is that there is a really well laid out thought process in the Code of Professional Conduct. This is the framework that we're supposed to follow. So this is one of 100 examples that might follow this exact same subordination of judgment discussion. So the purpose here again was just to walk you through what the code says and how to get there. So the note at the bottom there, the code very specifically states resignation may be your best alternative in this case. If Nick is convinced that everybody, including the audit committee, is doing the wrong thing to manipulate the stock price to where they want it, Nick should resign. We all would agree with that, I think. But the code specifically says that does not relieve him of his responsibilities in this situation, including his responsibility to raise the red flag to regulatory authorities, or after he quits, go to the external accountant and make sure it's considered. So there is one final step. Quitting and walking away, well, may be the right answer in a organization that has that many ethical concerns going around at all levels. It doesn't resolve you or absolve you of your responsibilities under the code.
Yeah, I think this with Nick, Mike, he's got to be honest and candid right there with the external auditors. So he certainly does want to let everyone above him know, I'm going to tell them this. And if he can't come to an understanding of why those adjustments are made, I would hope the external auditors are not the first ones being told, although I certainly would want to be told.
Yeah, I absolutely think there is a process that needs to be gone through, and it does not start with calling the accountant and calling your attorney. It starts with having some conversations internally, and the code is fairly clear that that's where you should start. And there are retaliation laws in place that you should feel comfortable doing that. Final thought real quick on this case study. There's some real clear language on confidentiality of the information of the employer that you're working at. And we get into occasionally some balance as to I have an established requirement for confidentiality within the Code of Professional Conduct, but I also have this requirement that I cannot allow something to happen without raising the flag. And basically, in a nutshell, the code walks through a process of how to get comfortable with which one of those is more important and appropriate. And I think in the case of fraud or illegal activities relative to financial reporting, it's not hard to justify a departure from the confidentiality rule if you've gone through the right steps internally first, but always consult with your attorney, consult with your legal counsel to make sure that we're comfortable that we're doing the right thing, because disclosing confidential information should not be taken lightly, even in the aspect of I'm trying to blow the whistle on something that I know is wrong. So final point there is just document. And I think through every step of this way, Nick should have documented the conversations that were had, who they were had with, and what the tone of them was and what the result was. Again, if Nick gets pulled in front of a ethics enforcement committee because everything fell apart at some point down the road, we want to have a record of the fact that Nick tried to do the right thing and comply with the code. So moving on to our next one, again, something that is on the surface seems pretty obvious. The director of accounting for a large nonprofit organization is the final signer on all major contracts with major service providers. The board has approved her to engage a marketing firm for a series of projects driving fundraising and some 50th anniversary blast out. And so the goal here is to find the best service provider to help through a campaign. It just so happens that the director of accounting's husband is a shareholder and senior designer at the marketing firm who has the best reputation in the industry for exactly what they're looking for. So on the surface, I think you would look at it and say, obviously, there is a potential conflict of interest. The person that selects the provider would have a potential to benefit from the selection of her husband's organization, but on the flip side, they're probably the best one to do the work. So what should she do and how should she go through it? So first thing is, as we always talk about, is defining what is the threat and do we have a threat. So when we talk about the conflict of interest section for members in business, one of the first things is determining whether a professional service or a relationship would result in a conflict of interest, and if it would a reasonable or informed third party conclude that same conflict of interest exists? So Mary may look at it and say, I'm clearly independent, I clearly am going to do what's best for the nonprofit, everybody should know that, but we also know and are aware that an informed third party might look at it and say, it may be the best organization, but there's still a clear conflict. So one of the examples that's listed relative to this, and I mean, exactly what we're talking about here is, am I responsible for the selection of a vendor when the selection of that vendor might benefit either me or an immediate family member? So code speaks very specifically to it, kind of an obvious situation, but there's a whole list of these obvious situations that are baked into the code that we generally don't read. It's really worthwhile to take a look. I don't know that I would read 193 pages worth of it, but focus on the key areas that are relevant to you. So if we've identified this conflict of interest, and in this case clearly we have, because it's exactly the scenario that the code calls out as one of 7 or 8 examples, we have to determine whether that threat is at an acceptable level. I think in this case, on the surface, I would say no. It's the final say on a contract with a shareholder who clearly will benefit from the selection of their organization. So members have to consider, the code says a couple of different things. One is what is the significance of the interests? What are the relationships? Here it's a spousal arrangement, it's a husband and wife. Clearly there's a tight relationship, shared financial interest in it. And what is the significance to undertaking the professional service? The more direct the connection, the more significant the threat. Again, I think this all supports the obvious conclusion that we have a potential conflict that is at a high level and we need to be concerned about. So what are the safeguards that can be put in place? What does the code of conduct specifically state in this example I can put in place to make sure that I am complying with my professional responsibilities under the code? First and foremost, I can restructure my responsibilities and duties, so I can remove myself from the selection process altogether. So Mary could remove herself and designate her associate director, designate somebody else in the organization, put a committee together that she's not part of. There are a number of things she can do to step back and say, I'm completely out of this process, somebody else is going to make the decision. Second is to obtain appropriate oversight. So I'm going to go through the process, evaluate the bids, and make a recommendation, but I'm going to let my board make the final call, and that's the oversight process. I won't make the final judgment. We've already talked a little bit about withdrawing from the decision-making process, similar to segregating responsibilities. And then finally, we can consult with third parties. If we think there's an out, and we think we can have some specific interpretation that says I can do this, we can track that down, but generally not a very successful process to go through. So I've clearly put in some safeguards. There's some other things I need to do that Mary's obligated to do in this scenario. First is to disclose the nature of the conflict to all relevant parties. If she's put in safeguards such as I'm removing myself from the decision-making process and I'm turning it completely over to a subcommittee who will make a recommendation to the board without my knowledge, all relevant parties need to be comfortable with that, most importantly in this case the board. We can't just give a small snapshot of the circumstances. The board needs to have the full understanding of what's going on and why I'm doing it and what those safeguards are, because we don't want Mary to get phone calls from board members saying, well, why are you not taking lead on this? It's your job. Who would you pick? We wouldn't want to put her in that circumstance or that situation, so we want to be clear on those. And then we also want to make sure that we've talked about there being more specific rules in certain areas. Governmental accounting, there's rules surrounding some nonprofit organizations. If they're tied to national affiliates, those affiliates might have rules. So there's things we need to make sure we're complying with, not just in the AICPA Code of Conduct, but on the outside. So I think in this case, you would come to a conclusion that if Mary removes herself from the process, creates a subcommittee of relevant individuals inside the organization who report directly to the board makes the final call, She's documented all of this process and removed herself from the process, and has made it clear to all parties that this is how she's staying objective and clean and clear on it. She's probably done the right thing, but that final question needs to be asked, particularly in a nonprofit world, is we have a perception versus reality conversation that would say, would a third party, so a donor who now is giving or considering giving significant dollars as part of this marketing campaign that now Mary's husband is taking lead on and is getting paid by the organization to do, would that donor look at the facts and circumstances and say, it's appropriate for this nonprofit that I'm about to give money to have selected the financial reporting director's husband to do all of this work for this major thing? So while we may have complied with the letter of the law and documented everything as relevant from the code of conduct, it's probably, or in many cases, a really bad idea to go forward with making the decision to use that entity for marketing if there is another viable alternative. So just things to keep in mind. But again, we could go through dozens of examples for conflicts of members in business and things that you face every day. And all of them would come down to it's a common sense outcome that actually has a framework and some process you can walk through to support what is probably the common sense answer you'd have come to anyway. But it gives you a framework to document why you're doing what you're doing. And in cases where, particularly a subordination of judgment, it gives you an ability to step back and say, look, I did the right thing and I've documented it all and I've protected myself. And in particular, as a CPA with a license on the line, I've followed the rules and done what I'm supposed to do, and I can move on and sleep well at night. So just two simple examples to walk through how the code is structured and how it really does apply a little bit more specifically and comfortably to those in business than it ever has before.
Great, thanks, Mike. I hope you've enjoyed some of these examples and some of these case studies, and they've given you some things to think about as you go about your daily jobs and your daily responsibilities. So we're very briefly, as we wrap this up, going to touch base on the Joint Ethics Enforcement Program, or the JEEP process. It starts off with a complaint being filed, and then there are preliminary inquiry and analysis done over that complaint. So really you don't have much control over whether or not a complaint is filed against you. Hopefully you're always doing the right thing and have the highest ethical standards, and there would be no reason for that to happen, but certainly there's a lot of ways that can occur. So respondents are then identified, and that's where you do not want your name to be. But if you have been identified, there's a case investigator that is assigned, and then opening letters are sent to the respondent. So this is the point at which you would be notified that you have been named in this complaint and that the enforcement program, they've decided to move it forward through the JEEP process. So evidence and interviews are collected. This is where your documentation could really save you. So document dates, times, meetings, discussions. So they collect all that information, and then the case is presented to this committee, and then the committee votes on the case and the outcome. So the possible conclusions of this investigation process is there's no violation. That is exactly what you would want if you're unfortunate enough to be named in these, and the investigation is closed. So nothing happens from that, and as I said, documentation could be the key to that. There could be required corrective action. So in a lot of cases, this is CPE requirements, additional trainings you have to go through, sometimes additional ethics trainings or code of conduct trainings, or pre-issuance reviews of certain engagements if you're a member in public practice. There could be a settlement agreement. In lieu of referring the case to the Joint Trial Board, the committee may choose to offer the respondent a non-negotiable settlement agreement. So you could accept that settlement agreement. Or you could be a referral to the Joint Trial Board. And if it goes to the Joint Trial Board, they'll have a panel that will take a look at the case and decide guilty or not guilty, and then determine the outcome of that, which may include having a suspended license or revocal of your license, or even things beyond that. So certainly not a process you want to find yourself being a part of. Think about these case studies. Think about how they apply to your job and your responsibilities. And if there's no other takeaway, document, document, document. That's what auditors love to do. We do tons of that. But think of that for yourself, for those of you in members in business as well. Any concluding remarks, Mike?
No, I appreciate the opportunity to go through at a little more granular level some of these conversations, but certainly those who are on the webinar today, I think the root of it is we are either ethical people or we are not. So it's great to learn about framework. I always chuckle a little bit about the licensure requirements to have a certain number of ethics credits. I do chuckle a little bit when you talk about ethics enforcement and the outcome maybe being more ethics CPE, because learning about being ethical does not make one ethical, and so maybe I'm a little cynical on that. But hopefully we gave you maybe not better ethics than you already had, because I'm certain that our folks on the line today have a very high level of ethics. So I don't know that we improved your ethical thought process, but I do hope that we gave you some tools to work through what rules are in place and how to navigate them as you think through some of the things you face.
Thank you once again for joining us for this webinar recap produced by McKonly and Asbury. We hope you join us for our future webinars. You can also stay connected to us and learn more about all of our upcoming events by visiting www.macpas.com. Thanks again and have a great day.